Good morning and welcome to our online press briefing on mortgage forbearance in COVID-19. I'm Andrea Priest from the Corporate Communications Group, and as a reminder, we are recording this event. Today we are releasing 4 Liberty Street economics blogs exploring the take-up rate and characteristics of those who participated in mortgage forbearance programs, the impact on participating households and small business owners, and the outlook for the mortgage market as forbearance programs end. These blogs are the latest installment in our continuing economic inequality research series. On the virtual dais today are Andy Howitt, Wilbert Vanderklau, Dong-Hoon Lee, and Joelle Scally. Following our presentation, we will open the meeting to Q&A, and I ask that you please hold your questions until then. With that, I will now turn it over to Andy Howitt.
Thanks, Andrea. Good morning, all, and welcome to the New York Fed. This morning, we're going to be talking about a new approach to providing assistance to homeowners. Mortgage forbearance gives mortgage borrowers the opportunity to reduce or pause their debt service payments in the face of hardship. It's not brand new. It's been used before, especially during localized natural disasters. But the COVID pandemic is the first time it's been available so widely, and as you'll see, it's had some important impacts. As Andrea mentioned, we'll break up the presentation into 4 parts, representing the 4 blogs you have in front of you. We're all speaking for ourselves, and the views we present don't necessarily reflect positions of the New York Fed or the Federal Reserve System. All of today's presentations draw on the New York Fed's Consumer Credit Panel, which is data that we draw from the credit bureau Equifax. As such, our focus is really on the borrowers and how policies, in particular forbearance policies, have affected them. So with that, Joelle, next slide, I'll begin with the first blog, which is a description of forbearance take-up. Okay. So next slide. The CARES Act from last spring made forbearance available to many mortgagors for up to 18 months. This referred specifically to government-backed loans, but the act also encouraged lenders to offer forbearance on their portfolio loans. And take-up was pretty quick. By May of 2020, 7.4% of all mortgages, or about 4 million loans, had entered forbearance. In the chart, the dark bars show the percent of mortgages entering forbearance, and the light bars show exits. The line shows the rate of forbearance as reported on credit reports. And so you can see that 7.4% as of May. And by June, you can see that forbearance exits, the lighter gray bars, lighter blue bars, began to outnumber new entries. And that has continued since last summer. But nonetheless, as of March, 2.2 million mortgages are still in forbearance as of March of 2021. Now, many of the loans in forbearance have been in forbearance for many months. More than half have been in since at least last June. Okay, next slide, please. So one of the main points of the blog and of a series is to look a bit under the hood of these aggregate statistics and get a sense of the differences in the effects of the forbearance program across different types of borrowers. And one way to do that is to look at the type of loan that's receiving forbearance. So first, let's consider FHA, Federal Housing Administration loans. These are government-insured loans. They offer low down payments, and they often go to first-time buyers or borrowers with lower credit scores. For these loans, forbearance rates were much higher. They're in the red on the chart on the right. Though for FHA loans, forbearance rates hit 14% in June of last year. Now that rate has come down, but it's still quite high at 11% as of March. And we can contrast that with the rest of the market. Loans securitized by Fannie Mae and Freddie Mac, they saw quite a bit lower rates of take-up to begin with, and now only around 3% of those loans remain in forbearance as of this past March. Next slide, right? A closely related dimension is income. Now, we don't observe borrower incomes in the Consumer Credit Panel, so instead we characterize the income level of the borrower's zip code using data from the IRS. And then we can divide neighborhoods into 4 equal groups, ranging from the lowest income to the highest. The chart on the right of this slide shows that, first of all, forbearance rose everywhere as the pandemic took hold in the early spring and in the spring. But it rose the most in the lowest income neighborhoods, and that's the light blue line that you can see rising close to 10%. And it remains highest in those lower income neighborhoods. You can also see that forbearance rose pretty sharply even in high income areas initially, but that it's fallen quite substantially in those higher income areas. And it's now clearly the lowest in the highest income neighborhoods. So the way we interpret this is that the forbearance programs have been important to our borrowers in many different kinds of circumstances, but it seems like it's been particularly important and had a particularly big impact on lower income borrowers. Next slide, please. A final source of difference that we thought was interesting is the loan status before the pandemic. Now, it's important to note, as we've been reporting for many months now, that delinquency statuses had reached really low levels at the end of 2019. Mortgages were very, very well performing at the end of 2019. But when we look at the relatively small share of borrowers who were delinquent in March, we see that they are far more likely to enroll in forbearance. And you can see that by the blue line here, the one that goes to the very highest levels, those are borrowers who, as of March of last year, March of 2020, were 90 days past due on their mortgage. And we can see that by June, 40% of those borrowers who had been 90 days past due in March had enrolled in forbearance. So 40% is a much larger number than we saw in other areas. If, for example, look at borrowers who are current, the light blue line that's near the bottom of the chart. Here we see that, this vast majority of borrowers who were current, the pattern there looks very, very much like the overall pattern because so many of the borrowers were current starting in March. And most of the other delinquency statuses fall somewhere in between the 90 days past due and the current borrowers. Okay, so next slide. So our summary of Blog 1, 4.2% of borrowers, or about 2.2 million borrowers, remain in forbearance as of March of this year. That's well down from 7.4% in June of 2020, but it's still a very substantial number. The borrowers who were most likely to take up forbearance were those with FHA loans, those who resided in lower income neighborhoods, and those who were seriously delinquent pre-pandemic. All of those are overrepresented in the pool of mortgagors who are currently in forbearance or who entered forbearance. And now I'll hand it over to Dong-Hoon Lee to examine what happens to borrowers in forbearance.
Okay, thanks, Andy. So in this section, I will take a look at what happened to the forborne borrowers and to their mortgages and to other non-mortgage debt that they had. So we are looking at the balance and their delinquency. Next, please. So the mortgage delinquency rate dropped with forbearance as an option. So the graph here shows the mortgage delinquency rate among those who took forbearance in April and May of last year, and that's in blue, and those who didn't take mortgage forbearance, that's in red graph. So as you can see, the mortgage delinquency rate, which is measured on credit reports, dropped between March and May 2020 as borrowers were entering forbearance. So as high as 8% of those borrowers were previously delinquent on their mortgages, and it dropped to 2% in May and stayed between 2 and 3% since then. So whether they stayed in forbearance or have exited by March 2021. So also, the delinquency rate of those who didn't participate in forbearance dropped as well, from around 3% to below 2%. So then what do these tell us? First, forbearance uptake was higher among borrowers who were already struggling with their mortgage payments, as Andy mentioned in the previous section. And some of their loans are now relisted as current, even though they were not making payments. And second, some of the borrowers with new struggles, but who are not delinquent before, they were entering forbearance and maintain their current status. And this favorable treatment of credit reporting was specifically mandated by the CARES Act. So here, just to give a caution, our measure of delinquency is based on what's reported on credit reports, and you might have seen other measures of delinquencies spiking up since they mark those in forbearance and skipping payment as delinquent. And also note that not all borrowers in forbearance skipped payment, even though they could without impacting their credit score. So this means that some significant proportion of people, between 30 and 40% in our measure, were taking forbearance as an insurance option against which they didn't file a claim. Next, please. So next, we are looking at what happened to other debt these forborne mortgage borrowers had, such as credit cards and auto loans. So the chart shows that the non-mortgage delinquency rates of people who are ever in forbearance, so that's in red, compared with those people never in forbearance, that's in blue. So here, two things come out. First, borrowers who have participated in forbearance had higher delinquency rate on other types of debt as well, even before the pandemic. And they were on a deteriorating trend before entering the forbearance, and the mortgage forbearance and saved money from it was not big enough to cure those non-mortgage delinquencies. And as a result, their delinquencies persisted. And in comparison, those borrowers who have never entered forbearance have maintained low delinquency on non-housing debt, that's in blue. So we see a selection pattern that those who are struggling in their mortgages and other debt were more likely to enter forbearance, and the gap between those participants and non-participants were somewhat persistent in the performance of other debt. Next, please. So we saw that the mortgage forbearance didn't help the delinquent borrowers come back to current, even though it might have helped prevent from further deteriorating. But then what about their non-housing debt balance? So for that purpose, we look at the credit card balance and find that credit card balances dropped since the pandemic for the overall people, and particularly more so for forborne borrowers. So in the graph, we see the credit card balance percent change from last March for forborne borrowers, that's in red, and the rest of the people in blue. Credit card balance dropped for both groups, but forborne borrowers have declined by 23% since the pandemic. And interestingly, forborne borrowers started with significantly higher credit card balance at about $9,000 compared to $6,000 for those who didn't participate. So 23% down from $9,000 is about $2,000 paying down on their credit card. So in comparison, in blue, borrowers who never participated in forbearance saw a smaller balance reduction with about 15% decline on average. So that would be about $900 in absolute terms. So you see that the forborne borrowers, they were paying like more than twice of their credit card balance compared to those non-participants in absolute terms. So go back, please. So the credit card balance decline does not only result from an active pay down on the debt, because about 1/3 of the credit card balance reflects the monthly transaction volume for consumption, and about 2/3 for the carried over revolving debt. So the larger decline among forborne borrowers may reflect either reduced consumption or a debt prioritization to direct extra cash from skipped mortgage payment to expensive revolving debt balances, and probably both have worked here. Next, please. So now we look at some of the heterogeneous outcomes, such as whether full-blown borrowers from high-income area pay down credit card balance more or less than those from low-income area. And we find that borrowers from higher income area pay down more of the credit card balance. So the graph here shows that from the top quartile of high income area, measured by zip code income, as introduced by Andy in the previous section, so that's in dark blue, the credit card balance dropped as much as 30%. And in comparison, in the rest of the area, borrowers living in other neighborhoods saw a 20% reduction. So the average of these four groups would be corresponding to 23% in the previous chart. However, these are consistent with the general pattern of credit card balance decline across income groups, such as higher income areas saw higher reduction in credit card balances, among those people who are in forbearance and also those people who are not in forbearance. So what explains these patterns? Cash diverted from full-blown mortgage payment paired with stimulus payments as well, and also limited consumption opportunities all have likely contributed to these declines. Next, please. So in summary, what happened to the full-blown borrowers? So their mortgage delinquency rate dropped, many of which by just entering forbearance. However, non-mortgage delinquency rate persisted, and credit card balance declined more steeply among the full-blown borrowers and among from higher income area. And in forbearance, about 60 to 70% of the people, they were skipping payment, and the rest of the people were making payments. And thank you, and I will pass it to Wilbert.
Thank you, Dong-Hoon. So far, we've looked at mortgage forbearance take-up by consumers overall. What we're going to do next in the third part of this presentation is look at a specific subset of consumers, which are small business owners. And we're going to analyze whether they are more or less likely to participate in these mortgage forbearance programs and whether they used home equity on their own homes to help their business operations through the crisis. So for this analysis, we merged the consumer credit panel data from Equifax with business-only information also from Equifax. Next slide. So what we find is a much higher take-up rate of mortgage forbearance amongst business owners. As you can see in the chart and in the red line, about 11% of small business owners were participating in the mortgage forbearance program, compared to 7% for consumers, 7.4% for consumers with a mortgage overall. Now, this is surprising because business owners on average tend to live in wealthier neighborhoods, they're slightly older, and they have much higher credit scores. So instead, they have a participation rate in forbearance that is much closer to those, as Andy showed earlier, to people in lower income areas and people with an FHA mortgage. So as was the case for consumers overall, you see that the forbearance rates were gradually declining over time for small business owners, but they still remain high. And overall, 17% of small business owners participated at some point since the beginning of the pandemic in a forbearance program. Next slide, please. So we're also able to link the participation rate in forbearance to the industry in which these firms operate. And what we see is a fair amount of variation in participation rates. As you can see in the chart there, we see relatively low participation rates for firms in the agriculture, forestry, and fishing industry. But perhaps not surprisingly, we see a much higher rate of participation in the accommodation and food services industry. Some 24% of small business owners in that sector are enrolled in the forbearance program since March 2020. And that's, of course, is a sector that was particularly badly hit during this crisis. And the participation rate in agriculture is only about 10%. So it's, clear, large variation across industries. We also looked at variation by firm size, and we did not really find a lot of heterogeneity in that dimension. Next slide, please. We also looked at other housing related borrowing by small business owners. And in particular, we looked at HELOC balances, so home equity lines of credit. So for consumers overall, and that's shown there in the blue line, we see a gradual pay down of HELOC balances over the year. And actually, that is a decline we've been seeing since the Great Recession. HELOC balances have been falling very, very continuously. And so, that we see that again, even for people, for consumers overall in the forbearance program. However, for small business owners in the forbearance program, we see a jump increase in the HELOC balances of about 3.4% between February and May. And so what this is indicating is that small business owners were drawing on their existing lines of HELOC accounts at the beginning of the pandemic. Over time, they started repaying some of these balances, but even at the, more recently, there is still a gap there in how much they have repaid over this period. Next slide, please. So finally, as we did for consumers overall, we look at delinquencies on non-mortgage balances. And so the blue line that you see there is the one that we looked at earlier. And what we see is that consumers overall who are participating in the forbearance programs, their delinquency rates on non-mortgage balances actually increased slightly during this period. For small business owners instead, we only see like a temporary spike in April, but then after that, it's actually, sorry, in July. But after that, the delinquency rate has been very flat. So for small business owners in forbearance, it seems that their participation has helped them avoid this increase in non-mortgage debt delinquencies during this period. Next slide. So in summary, we find evidence of disproportionate financial hardship experienced by small business owners. They were more likely to enter forbearance on their mortgage and also more likely to borrow against their home equity during the first phase of the pandemic. So these coping strategies complemented other programs such as the PPP program and the SBA loan programs. So I'll now turn it over to Joelle Scally, who's going to discuss what's next for forborne borrowers.
Thank you, Wilbert. I'm going to talk about our final blog post in this series, which is we're going to talk about how long borrowers have generally stayed in forbearances. We'll talk about who's left in forbearance right now, that it's been about a year that these programs have been available. And then, how we see this rolling out as the pandemic sort of winds down. So the first thing we do in this blog post is look at the duration of forbearance participation. Now, the average participation was about 5 months. So that was overall the average for borrowers that have spent any time in forbearance. But one thing that is important to note is that about a third of people that did enter in forbearance at some point were only in forbearance for 1 or 2 months. So they may have entered quickly. As you saw in the first slide in this presentation, the rate spiked very early on in the pandemic, and then it came down. So about a third of participants were only in 1 or 2 months of forbearance. And there's only 12% who have basically taken advantage of the entire 12 months. Now, we had a small delay in terms of how these forbearances showed up on credit reports, so we're calling the maximum 11 or 12 months. Although the maximum possible length that borrowers are able to stay enrolled is about 18 months now to the CARES Act extensions. Now, one thing that I need to draw attention to on this chart that really offers a key contrast from the recession, from the Great Recession, is the gold components of the bars here. So these are borrowers who exited their loan. These are borrowers who were in forbearance at some point in the last year, but they exited forbearance through prepaying their loan. So they would prepay their loan either to refinance their loan, possibly into a lower monthly payment, or to sell their home. and recoup some of that home equity, keeping in mind that home equity right now in nominal terms is at an all-time high. So these borrowers may have actually sold their home and taken out that home equity. Now, this is an exit route that was not available to most borrowers during the Great Recession when house prices had collapsed. Many borrowers found themselves underwater and unable to pay their mortgages, and the only real way out was through either a foreclosure or a short sale. Now, on this next slide, we look into the borrowers who are remaining in forbearance. So on the left-hand side, we look at it again by zip code income, which is the same. We're merging those credit report zip codes in with income data from the IRS, which you saw earlier in this presentation. So we see that borrowers who are in the lower income zip codes are much more likely to remain in forbearance compared to those in the highest income zip codes. Only 3% of the borrowers who are in the higher income zip codes are still in forbearance at this point. On the right-hand side, we look at this by credit score, and you see a very pronounced relationship where the borrowers in the subprime credit score buckets are much, much more likely to have both entered forbearance and still be in forbearance at this point. Where in contrast, borrowers with the highest credit scores are very unlikely to actually still be in forbearance. Only 2% of them are still participating as of March 2021. Now, one sort of interesting phenomenon that's happened because of these forbearance programs is that credit scores have increased this year at a rate faster than we've seen in other years. Now, credit scores typically increase for borrowers as their credit history increases. So as someone gets older and they have a longer credit history, we do see an improvement in scores. But this year was a little bit unusual. And in particular, the credit score increases were steeper for forbearance participants. They were the most steep actually for forbearance participants in the subprime score bucket. In fact, we saw an average 59-point credit score increase for subprime borrowers that participated in forbearance. Now, the reason for this is that for subprime borrowers, their credit reports typically are marred by missed payments that keep their scores down. But the option to enter into a forbearance program and avoid delinquency during what's been a particularly difficult year has really protected their scores and, in fact, given them a bit of a boost by providing a clean payment history on their mortgage for the last year. So in summary, we see that the durations had, for many borrowers, been quite short, and only 12% of borrowers have taken advantage of the entire year of forbearance that's been available so far. Now, those remaining in forbearance are increasingly borrowers from lower income areas and who had lower credit scores before the pandemic started. Now, there is one thing that I don't have a slide for here, but it's a really important thing that I think we're able to do with these estimates. So one thing that we can make a sort of cautious estimate and or pessimistic estimate and say that of the borrowers who are currently in forbearance that are not making their payments. Now, these are the borrowers that are most at risk when the programs end for becoming delinquent. So we could pessimistically assume that if all of these borrowers become delinquent after the program ends, we could see a potential increase in the delinquency rate of it would be a 2.9 percentage point increase in the delinquency rate. Those are the remaining borrowers that are still enrolled in forbearance and not making payments on their mortgages. Now, this is, of course, a very steep increase from the 0.9% delinquency rate that we're at right now, but it still is considerably lower than the 6.3% that we saw back in 2010. Now, to wrap up, what we've seen here is that the CARES Act has been very, very successful at avoiding widespread damage on credit reports on the consumer side. Now, of course, it's important to keep in mind that, these payments are going to have to be made eventually and someone's going to be paying them. Now, credit scores also, we've seen this credit score increase over the last year, but one thing to keep in mind is that credit scores actually may be less informative. They're a really important tool for lenders to identify creditworthy borrowers, but with the protection of the forbearance programs, some of that may be muddled. Now, our cautious estimates suggest that mortgage delinquency rates will probably increase when these programs end, but probably not to what we saw in 2010. Although I should please keep in mind that this is really meant to be a framework to think about the exit of the forbearance program and not how the overall economy or the housing market evolve. Because the economic conditions and the general evolution of these supportive policies for households will really determine how stable the household sector remains as the pandemic and the recession begin to ebb. Thank you. I'll turn this back to Andrea.
Thank you, Joelle. We'll now open this up to questions. If you would like to ask a question, please raise your virtual hand, which can be found at the lower right-hand corner of your screen. Once you've asked your question, please lower your hand. And if you're having technical difficulties, you can type your question into the Q&A box with your name and affiliation. Sandra? First question is from Megan Lanhart.
Hi guys, thanks so much for hosting this press briefing today. I was curious, the CFPB has proposed halting foreclosures until 2022, in part to prevent this wave of foreclosures. Based on your research, is there any reason to do so? I know Joel seemed to indicate that we're not going to see, the same level that we did during the Great Recession.
Well, maybe I'll start on that and invite my colleagues to join in. I think that even if we don't see levels of increased delinquency that rival those of the Great Recession, that still could represent a significant amount of hardship for the households involved, of course, and it would still be a relatively sharp increase from where we are today. So while I don't think we want to pass judgment on the CFPB's policy proposal, that's a matter for policymakers, I'd say. We would say that there's certainly a substantial number of households who are still benefiting quite substantially, it looks like, from the provision of mortgage forbearance, and I think we would anticipate that those households might face a little more hardship when these programs end.
Next question from Brian Chung at Yahoo Finance.
Hi there. I guess I want to direct this question at Wilbert on the specific impact on small business owners. I guess, why do you think they lean so heavily on HELOCs as opposed to, many other programs? Well, I guess maybe not in opposed to, because I guess maybe they would have had multiple avenues to try to get access to cash early on. But yeah, I guess, why do you think HELOCs?
Well, I think for what we actually see is not an increase in HELOC originations. So it's just people drawing on existing HELOCs, so lines of credit that were already there. And so you could think of it as a precautionary move. And for some business owners, this might have been an additional way, to handle, the expenses during this period with insufficient revenue. So we are not able to look at how many of these business owners are also participating in the PPP program or other programs. It could be small business owners making a choice between either going in this forbearance program or trying any of the other loan programs. But again, we are not able to look at the overlap between those.
Else want to add anything?
Maybe I'll just add that, as Joelle mentioned, I think during her section, home equity is by some measures at an all-time high in nominal dollars. So that is an important factor. It's also not an all-time, but at a recent high in terms of the share of the property value. So that's kind of a cyclically adjusted, if you will, number, or a number that's not so subject to just the inflationary pressures in the economy. So it's in other words, there's more room, I think, for households to borrow against their homes than there has been in recent years.
One thing I do want to just add on to that is that the participation in the forbearance program in itself is a way to delay those payments. And you could imagine that the preserved cash simply from participating in those programs, and we did see that very high participation rate among the business owners, they were also taking advantage of their first mortgages as a way to preserve cash.
Next question from Janelle Mart at Reuters.
Hi, yes, thank you. I wanted to ask about the small businesses and if there was anything in your findings that gave insight as to whether they also had lower rates of business failure because of being able to tap into their mortgage or participate in this program.
That's a really great question, and it's something that we would like to look at. We've not done so far. I think there is a general question of, the relatively low bankruptcy rates that we've seen in small businesses, and it'd be very, very interesting to investigate how much access to these programs, forbearance programs, as well as HELOC draws had in terms of preventing bankruptcy.
Okay, thank you. Next is, I'm going to botch this, so I apologize in advance. Deacon Hyatt from The Balance.
Thanks. It's Dickon Hyatt from The Balance. And I was just wondering, is there any number in your research that would point to an indication of how many people were prevented from losing their homes because of the forbearance program?
Well, I'll take a crack at that, but it's a very complicated question because it requires forming some kind of counterfactual as to what would have happened without the programs. And so I'll make a couple of comments on it. What I would say is that, first of all, I think our results suggest strongly that the people who entered forbearance on average and typically were people who were facing distress and that would have had at least some difficulty making the payments that they were able to reduce or to miss during their period in forbearance. However, whether that would mean that they would have lost their homes absent these programs is, as I say, a more complicated question. So one option might have been for some of these borrowers to sell their homes because they, in general, will likely have positive equity. They could pay off their mortgage by selling their home and avoid foreclosure. Now that, it depends on your definition of losing the home. That could be considered losing the home. You sell it, but you have to move somewhere else. So that I think is one thing that has quite possibly been forestalled by mortgage forbearance. And then a second question is, we haven't seen large waves of homes being put on the market because of pressure on borrowers who are having difficulty making payments. That is in part probably responsible for a very, very tight housing market that we observe today. So there's very low inventory of houses for sale. Had these programs not existed, that inventory of houses for sale might have been considerably higher, meaning that there might have been some more downward pressure on prices, and that could kick off. So there's a whole complicated sequence of events that could have happened had these programs not been in place. And it's very difficult to say, of that sequence that I've just laid out, how much credit does mortgage forbearance deserve for stalling that sequence? I suspect my colleagues might have
just one addition to that discussion is that we did see, in one of the charts, I think in the second part that Dong-Hoon presented, that one way of exit out of this forbearance program were people selling homes. So it is true that some people went in this forbearance program, decided to sell their homes, and we don't know whether they would have done that without being in these circumstances. People are selling all the time, but it could be that the hardship and the forbearance programs still made them think that they needed to sell and move. Again, that's an interesting question. We cannot really see the motivations behind these outcomes, but we did see quite a lot of people selling who were in the forbearance program.
Thank you. Next question from Jennifer Serain from Bloomberg.
Hey y'all, thank you for taking the question. Joelle, I had a follow-up question for you around the idea that credit scores may be less informative. I guess, what do you think that might mean for, banks looking to, it seems like a lot of banks are talking about, wanting to increase their loan balances and wanting to kind of be a part of this recovery now. Does that, slow their roll a little bit in terms of the data that they're looking at to determine, what borrowers might be creditworthy or the borrowers they want to make these loans to?
Well, one thing that we can say about this is that we know that that lenders do look at the full picture. And I mean, in particular, we do link to the agency requirements for even refinancing loans. And we found that in some cases, the agencies are requiring regular evidence of payment for those who are refinancing their loan. So, a forbearance participation doesn't preclude someone from refinancing, but it is taking these things into consideration, or at least the agencies are when they set up the requirements. So, I think they're still looking at the whole picture. And in any case, it may actually mean that a borrower who has had the opportunity to skip a year of payments, paired, of course, with a lot of the fiscal supports that have gone to households, may be in a better position. Some of these borrowers may actually be in better positions to repay debt.
Thanks, Joelle. Next question is from Paulo Roca from American Banker.
Hi there. Thank you for doing this. I apologize because I think the answers you probably touched on in some way, but I'm curious if you could just expand on your kind of rough conclusion that it seems improbable that we're going to see, kind of great recession-like delinquency issues. I mean, what's kind of the big driver? Is it that, the math that people are already making, good chunk of people are making payments, or that, we're kind of well on our way to recovery, whereas, in the Great Recession, we were just entering a recession, or the fact that, the rise in equity price and home prices kind of gives people a way out? I know it's somewhat like a lot of moving parts, but any more clarity you can provide on kind of the top reasons behind that would be helpful.
Okay, well, go ahead, Wilbur.
Okay. I think, what Joelle mentioned was like the most pessimistic scenario for delinquencies of people who are still in forbearance. And what she showed is that they are disproportionately more likely to have been delinquent even before the pandemic began, and also are more likely to be from lower income neighborhoods. So, we anticipate that they are still going to be struggling. Of course, this was a deep recession, and coming out of it is going to take time. And so it really depends a lot on what's going to happen and what type of exits these people have out of forbearance, and whether servicers are going to give them other options. They clearly are going to need more help, to stay current if they have to start, paying.
And I would just add to that that the estimates that we're providing here are really about what we would expect for people who are emerging from forbearance. It's not really a forecast of what we think will happen to delinquencies over the next year. It's just sort of if you will, the partial effect of the expected end of forbearance programs. And that's important because, touching back on some of our earlier answers, that kind of assumes that house prices don't fall. If house prices were to fall, then that would put the mortgage market into a different situation. And so, we've done some other work that looks at those kinds of scenarios, but that's not what this estimate that we provided at the end of today's briefing is about. It's really about just the effect of the expected end of mortgage forbearance programs.
Thank you. Jenny, did you have another question? Your hand is up.
Sorry about that. No, I'm all set.
Any other questions? Any closing remarks you want to make, gentlemen, and Joelle?
Would just say thanks to everyone for attending, and looking forward to future conversations on these topics.
Thank you. Yeah, thank you all for joining. The blogs and presentation are posted on the website, and the recording of the event will be posted soon. If you have any other questions, please feel free to reach out to me or to Mariah Macy. Also, please remember that the embargo lifts at noon today. Thank you.